Everybody, welcome to the Investment Syndication Simplified Meetup. My name is Ryan Gibson, and I'll let Igor and Tyler introduce themselves.
Hello, everyone. My name is Igor Pechkowski. Work with Windermere Bellevue Commons. I'm an investor here in Bellevue, Washington. We seek for properties on the market, off market, single family and multifamily, of where we can increase value and make income. That's what it is. Tyler, you?
Sure. My name is Tyler Thomas. I focus mostly in Seattle. And Igor and I do a lot of creative land use transactions, which requires a lot of city discretionary approval and research. And so we connected with Ryan to further kind of the intellectual knowledge base of deeper into the investment due diligence side of things, and not just the deals themselves, but also on a passive side, saying, okay, how can you evaluate whether something's safe and whether it's really worth it? Because we like to create value every which way we can. And so that's where, getting that transition from doing something yourself to investing passively, can cause a disconnect. So we love to share how to maybe make that bridge for people.
Great. And my name is Ryan Gibson. I work and started co-founded the group, Spartan Investment Group, and we do syndications. We're an operator of self-storage, self-storage and RV parks, and we do a little bit of manufactured housing as well. And we've raised about 30 million in private equity to date. We have about 100 million in assets under management, and I have a very big passion for sharing education on investing passively. So this is investing in a exempted offering like a private placement that is an exemption to filing a full security with a state or federal, and having investors come into a deal that allows them to participate passively and also take advantage of all the tax write-offs and cash flow and upside of the deal. So we started this group not to necessarily teach somebody how to go out and buy single family homes or multifamily or something like that. It's the purpose of this group is, not everybody needs to be a multimillionaire or billionaire to buy an apartment building. You can partner with somebody who has 30, 40, 50 years of experience across their team and buy an apartment building or storage or flip a house or do a development with a group that has more focus on it and more experience on it. So this group is going to educate you on how to analyze those deals and eventually, increase your investor sophistication. So we started this a couple weeks ago, and we're going to have a website pretty soon and a newsletter, and we're going to really grow kind of the marketing. But we're just sort of kind of building content. We're going to have a YouTube channel where these presentations live. And we're looking to sort of, the mission of the group is to enhance passive investor knowledge in the greater Puget Sound region. So this is a local meetup. This is a Seattle, Puget Sound based meetup that eventually, hopefully, will come back, will turn into a face-to-face and more networking when COVID has been put fully in the rearview mirror. But for now, it's a Zoom call, and I think we can still do a lot of good networking that way, but that's part of the networking community. And then hopefully this group doesn't turn into a pitch fest, but also provides quality opportunities and the ability to visit some live projects. So we don't just study the PPMs and the subscription agreements and the operating agreements and everything that goes into a private placement, but we actually get to see it actually happen, right? So we get to see a deal that's live. So we hope to do that very soon, not just between the three of us, but other operators as well. So with that, we didn't do this last time, but I'd love to just quickly, maybe we'll wait to the end. We'll do introductions, but we'll just go into tonight's presentation very quick, and then we'll open it up for questions and an introduction. So maybe before you ask a question, just say who you are, where you're from, kind of what you're doing, but we'll hold questions to the end. Before we get started though, any other housekeeping things, guys, that I missed? Good. Okay, perfect.
I think you're right on.
All right, perfect. So what metrics matter? So when we're in a deal, when you're in a private placement syndication, the brass tacks, metrics are super important. So, let's just set aside, somebody's experience or ability to hit these metrics, or, the trust in the operator, or the potency of the deal, or anything like that. Let's just talk about just the metrics. So when you're looking at a syndication, what things are you going to see, and what do they mean, right? So ideally, what you want to do here is you want to be able to analyze the different metrics that you would see on a project, or different financial metrics or targets, and then understand what each one of those things mean. And some people might think this is the most basic information you could provide, and some people might, I think even the most experienced people might take away a little bit out of these metrics. So, looking at this is a real live deal that just went out. It's actually a 1,800 unit storage portfolio that we're buying at the end of the month. And these are some metrics that were presented to investors. And I just want to go over some of the basics. And the first one I want to go over is equity multiple. Equity multiple is a 1.9. So for a Class A member, we'll just focus on the Class A members here. We'll just dismiss the Class B and C members for the moment. So Class A member getting an equity multiple of 1.9. What does that mean? That means that for every dollar that you put in, you can multiply it by 1.9, and that is the expected return that you'll get from the offering. So if you put in, $50,000, you would get 50,000. And it was a 2.0 equity multiple, you would get $50,000 at the end of the deal. So it's simply just a multiple of how much you're going to expect to earn. So that's what an equity multiple is. And that's super important when you're looking at a deal and you just want a quick, like, what am I going to earn in 5 years, right? And if it's so whenever I see equity multiple, the first thing I want to know is, okay, that's the equity multiple, but what's the timeline, right? So, in syndications, it's pretty typical to see a 2x every 5 years. So you double your money every 5 years. So if somebody has a 2x over 10 years or a 2x over 1 year, it could be a pretty big variety, the same multiple, but one knocks it out of the park in a year, and one potentially knocks it out of the park in 10. Now, like I said, we're not going to get into, the reality of being able to hit those numbers, just what those numbers actually mean. That's for a different call. We will talk about that though, how to evaluate an operator and do due diligence on an operator. And then target annual return is another one that you see, and that one's really fuzzy, and you really want to make sure you understand what they're doing with that one. So target annual return is pretty common. That's this target here, 17.9. That's basically adding up all of the operating distributions or cash flow and all of the money that you would make in a liquidity event, smashing those two numbers together and dividing by how many years the investment goes on as a percentage of money invested. So essentially, let's say every year you made $1,000 of cash flow for 5 years. So you made $5,000 in cash flow, and you made another $5,000 when the property sold in year 5, right? And you invested $50K. So you're making a total of $10,000 for that investment. So you want to know that over 5 years, you're making $2,000 a year, and you would divide that into your total invested, and that's how you would know what your target annual return is per year. So in other words, you're making 4%, right? That's a 4% target annual return. So that's kind of another quick wag. So when people are displaying metrics, it's sort of like, you can kind of display the best ones first and all that, but you've really got to understand how it gets down to it. But the most important metric is the one that we're going to talk about tonight, which is IRR. IRR is a very, very complicated formula that you see at the bottom right. I don't even know what half of those things mean. I couldn't memorize, and I don't have this equation memorized. But fortunately, Bill Gates does. And in Microsoft Excel, IRR is calculated in Excel very easily. And the IRR is basically the most comparable way to compare deals apples to apples across any asset type or any asset class and truly evaluate what the deal is producing for you. So if Igor comes to you and says, hey, I got this 30 townhome development in West Seattle, it's amazing. And I come to you and say, I've got this storage deal and it's amazing. And you want to compare the two, putting aside any risk or ability to hit returns, IRR would be the calculation and the formula that would be able to compare those two investments to see how you would perform, right? Now you might like storage, or you might like townhouse development, you might like Seattle, you might like Texas, depends, right? So there's a lot of variables that go into it, but the brass tacks comparison on the projection is the IRR. That is the most comparable metric. So just reading from the screen here, IRR is the annual growth an investment is expected to generate. It calculates ROI, but is different because it factors in time. And we're going to go through a real example in just a minute on how the same deal that returns capital earlier hits a better IRR than a deal where it pays the same amount over the period of time, but it all comes out at the end, right? So, so that's the next example here. So when we look at this deal, we've got a $50,000 investment, and this is one deal that has cash flow. So in the first year, this is actually a real deal from one of our storages that have been in our portfolio for about a year and a half, where it cash flowed $3,000 in the first year, $3,900 in the second year, $5,400, and then in year 4 there was actually a refinance event and some capital was returned, and then year 5 there's a projected sale and there's profit. So based on this cash flow, the annualized ROI, like we calculated earlier, was 16.1. So if you total up the total return, you divide by what you've invested, and you get an annualized return, it's 16.1%. But the IRR is 15.3 or 15.13. So that factors the return over time in that very calculated formula that we show, the complicated formula that we showed on the previous page. However, this is the same deal, the same returns, except that we took all this cash flow and just added it into year 5, right? Same investment amount, no cash flow at all. So there's no cash flows in year 1 through 3. We had the same liquidity event in year 4, and the reason why this is 30,000 and that's 32 is because $2,372 was cash flow. So what we're saying is we're returning 30 grand here, and here you're returning 30 grand plus $2,372 in the refinance event. And then in year 5, there is a profit from the sale of the deal. Now, if you noticed, same deal, one has cash flow, one doesn't have cash flow, same total proceeds, right? Same annualized ROI, but the IRR is less. So when you're looking at this deal versus this deal, this one cash flows, this one doesn't. It has the same proceeds. You're going to get paid the same at the end of 5 years. However, your IRR is going down because there's no cash flow. So I really wanted to kind of show this variable in IRR, because this is really the only comparable way to measure how the performance of the asset's doing. Now, if the deal on the bottom, it doesn't mean you always have to have cash flow. If the deal on the bottom paid out more at the end, the IRR might exceed this 15% or be about the same, right? If maybe there was a $20,000 more paid out at the end, that might increase your IRR to beat the cash flow. So sometimes cash flow really can amp up your return, and sometimes you're going to really have to bolster the sales proceeds or the refinance proceeds to get your IRR up. So that's kind of just kind of an example of that. So one thing I'll say here is that, think about it. If you had $3,000 back in the first year on your investment, you could take that money and go invest it somewhere else, right? So that has value to you coming back earlier. And that's why IRR is important to look at. The only other thing here that, I know we kind of touched on it a little bit, but, if someone comes to you and says, hey, I've got this ground up development, project I want you to invest in, and you look at it and you say, wow, this is a great return over 5 years, maybe it's 2.2 or 2.3x. Know where you are on the return risk curve, right? So, this core investment risk is very, very low risk, but a very, very low return, right? So this is basically where you are in the risk reward. Core plus, so core might be something like a triple net tenant of a 40-year building like a CVS or a medical office or something like that. That is something that's super stable. It's on Main and Main. The tenant is a A+ rated tenant. It's going to, the lease is going to be there. The cash flow is in place. It's a great market. There's very low risk. There's very low return, right? So that might return you 2 to 5% IRR, right? So the bottom here, we've got kind of the returns, right? Core plus is like, you're buying a stabilized portfolio. So you're buying, maybe in a secondary or tertiary market. So right now we're looking at an 8 portfolio storage, and that might be closer to a core, right? Where you're just taking over existing cash flows. You've got some operational turnover and some things like that. It's not as stable as a 40-year triple net tenant lease, but you've got, it's a stable deal. Value add is squarely where this deal falls in line. So we're actually a little bit higher than that on our return projections. But value add is like buying an existing business or buying an apartment and taking a bunch of units offline, doing the rehab. You've got turnover of tenants. You're buying something. Maybe you're adding on more units to existing cash flow. You're doing some more work, and you're introducing more risk to the risk return profile curve. This also plays into the market, right? If you're buying in a market that's in, a tertiary market, that might make it more of a value add play. So there's a number of factors that go into it, but you'd expect to see between 9 and 13% IRRs for a deal like that. And opportunistic is the most risk you can take. So by definition, I consider opportunistic anything that has a ground up development component with no existing cash flows. So you're buying raw land, you're developing a neighborhood, you're developing a storage, you're developing multifamily, you're developing a single family residence, something like that. That is an opportunistic, that's a deal that you're buying, and there's some inherent risk in the entitlement, permitting, and the speculative nature of the investment. And that one I would expect to see 14 plus. Some ground up development projects I would expect to see in the mid 20s, the low to mid 20s, sometimes even pushing 30%, depending on how much risk there is. So, and the last one I wanted just to go over is just cash on cash return. So cash on cash return is the cash income earned on the cash invested in a property. So basically it measures the annual return the investor made on the property in relation to the amount of the mortgage paid during the same year. So really, in absence of an IRR, it's a calculation you can do, that basically clocks your distribution. So, you've got, I think I got a good example. You've got a deal here. We'll just keep it simple. You got a deal. You put $50,000 into the deal, right? And in the first year, it cash flows 4%, right? So 8%. So in the first year, you earn $4,000. Your cash on cash return in that year is 8%. So you take $4,000 of cash flow earned, and you divide it by the cash you invested, which is $50,000, and it's just 8%. So when you're looking at a deal, I would probably say, what's the cash on cash return each year in my investment, right? What is the IRR? What is the annual return? What is the equity multiple? And what is the timeline to achieve those things? And that is really kind of how you that's a kind of a quick scan of like, do I like this or not? And you'll start kind of getting your own preconceived, kind of your own criteria. So you'll be like, I'm a cash flow investor, or, I'm a set it and forget it. I'm okay with ground up development. If it takes 5 years or 10 years, I'm looking for that good multiple at the end. I'm a little bit more, I'm willing to take risks, And, that I'm trying to, really jazz up my, my returns, right? If you're more of a, cash flow person where you're trying to replace income, so you're saying, hey, I'm a, high income earner, I've made a bunch of money and I want to, place it in something that, clips a coupon or gives me a distribution every month or every quarter, you might look for that cash on cash return. And that's what this speaks to is, what is the cash on cash return annually so I can start to replace income with my investment. Annual rate of return, this is different than like annualized ROI. This is something that calculates essentially the, it's kind of looking at things as a 12-month period. So it kind of scales down the investment to just look at what you get in 12 months. So it looks at the ending value divided by the beginning value. So if you had a house you bought for $100,000 and you sold it for $120,000, that would be the ending value and the beginning value, and that would equal your annualized rate of return, right? That's the most basic calculation as well. And you might see that kind of factored into the return structure. So, guys, that's all we have. I wanted to keep it short and to the point and leave time for questions. So if anybody has a question, you're able to unmute. This is the first time we've kind of used this Zoom with this ability to kind of make conversation, but yeah. Any questions?
Don't be shy.
One thing I'll say too, oh, go ahead. Are you going to ask something, Amit?
Yeah, Ryan, hi. Thanks for the talk.
Sure.
So I'm Amit. I'm based in Sammamish, and I'm interested obviously in investing in some good deals. I just wanted to ask you, what's the difference between NPV versus IRR, and how do you differentiate, or which is a better indicator?
Yeah, so net present value.
Yeah.
Tyler or Igor, did you want to take this at all, or do you want me to take a crack at it?
I can take a crack at it.
Okay.
I mean, typically you're going to have a predefined discount rate or like a return on your money that you're going to look for, or at least a deal that you invest in is going to be able to generate. Typically, you're going to have that preconception and that goal. So that's where you can use like the net present value to quickly look at whether the net present value exceeds the amount that you put in, or if it's below, then you just say that's not the investment for me. That's the way I would use net present value, just for a quick check. And obviously there's more you can use it for, but IRR is a really useful tool, just because of that. It's for me, it's more relevant to compare different investments. And you can also use IRR to compare different metrics if you get more advanced, like cap rate, because IRR and cap rate are the same if future cash flows stay the same. And there's all that complexity that you get into, but like IRR is an easier metric to just be like, okay, well, regardless of what the net present value is, from one investment to the other, and that equity multiple and how that changes on that aspect, I can just say my rate of return is changing by 2% versus 1% on this investment. And that's so much easier to conceptualize. And I was going to say something else, but Ryan, why don't you take over and simplify?
No, that's great. I don't have anything to add to that. That was a great description. Yeah, I mean, I'm kind of a big IRR guy. Net present value, like you said, Tyler, really just kind of a, what's it going to be? Where's it going to end up? I'm more concerned with, kind of the IRR, because it's really, I think, in my opinion, I think it is the only way that you can truly compare apples to apples across asset class type, giving the, and again, this is not considering, what the investment is or isn't, or the risk profile and things like that. So I always say when you have a ground up development, I never like to see, I don't care what it is, I never like to see an IRR less than 18 or 19%, and over a 5-year projection. I don't like to see anything less than 5 years because I feel like ground up development always takes 5 years or more. And I feel like it should be, unless there's some special circumstances. But I mean, I've been in deals where the project took longer than it's projected, and it really just erodes your IRR, because you've got to look at sort of the total return and then make sure that there's enough years to actually drive a sufficient IRR for making that investment. Whereas in a cash flowing property, I'm less concerned about maybe the realness of what the IRR projects, because if it cash flows right away, there really isn't a whole lot of waiting for performance, and assuming that it's a good operator. So anyway, good question.
So then if, say, the discount rate changes every year, how do you account that in the IRR?
Good question. If the discount rate changes every year.
I mean, are you talking about the reinvestment rate?
Yeah.
Okay, yeah, that would take more than a modified internal rate of return calculation using a spreadsheet, right? You'd have to manually program your reinvestment rate for each year, which is maybe not practical because now you're forecasting the future, and nobody can do that very effectively if you try enough times. So, but of course, for your own portfolio, you could try and put a thesis around, whether it's going to be 3% one year, 5% the next year. Let's say that it takes you a while to build up to the next $50,000 clip that you can put in for the next deal. Obviously, that will change that reinvestment rate for a syndication. But that gets into some Excel math that really isn't coming down to the evaluating the performance of an investment, but rather your own kind of portfolio, right?
Yeah.
That's a good point.
Okay. Okay. And then just the second question was around that, the two comparisons. So one like gave a higher amount towards the end versus the other. So which one is a better approach? Is it the top one or the bottom one?
So I would say it's the top one in this instance, unequivocally, because you are getting a return on your investment early in the project. This was just to kind of trigger a discussion, right? So, in this deal, like I said, the cash flow comes sooner, and then in year 4, there's a refinance event in both scenarios that returns $30,000. And what I've done just to drive the point home, again, there's never going to be a situation where you have the same deal and you're comparing. Well, maybe there might be, I don't know. You're comparing getting cash flow earlier versus later, and you have the choice, right? It's just to drive the point home of why an IRR might be negatively impacted based on when you might expect to receive cash flow. So this deal gives you the cash flow ahead of time, and it drives up your IRR. So you have this money to go invest. You have it to place in your bank account or whatever you're going to do with it. And so the IRR favors that. On the bottom, it doesn't. So I would definitely pick the top. If everything was held equal, I would prefer the top deal over the bottom deal. So. And
then, of course, from a tax perspective, the top one is better also, because in the 5th year, you don't get a huge chunk of money.
Yeah, so that's a great question. And in this particular case, because I'm familiar with the details of the deal, it actually depends. So in this top example, for example, both situations, you would get something called bonus depreciation. And so what happens is in the first year, we do a cost segregation study, and the deal is broken out, and we get bonus depreciation, which we take 100% of the short-term life on the deal, and we apply it all to a loss. So in this instance, the investors got about 30% of the purchase price, and the purchase price was $6 million. So 30% of the purchase price, they got a deduction in the first year. So, pretty healthy write-off. And then that flowed to their K1 that they receive, and then they get depreciation. So in the first year, they got something like, I don't know, $20,000 for every $50,000 invested in a loss. And that loss can be applied to passive income, not earned income, unless if you're a real estate professional like Igor or Tyler that work in the field more than 750 hours a year. But if you are just a passive investor, you can only apply it against passive losses. So let's get down to the brass tacks in that. So here, that $20,000 K1 loss is gonna shield all of this cash flow income. So you're not gonna pay taxes on that. And then in the end, you're gonna have the same catch up that you would have here. Now in this situation at the end, because you're gonna have recapture tax at the end, flat 25%. Now here, you're gonna get that $20,000 loss. And so you may or may not need that $20,000 loss because you may not have passive income that you need to shield from other investments. So in this situation, you might have no benefit to it, right? But you're gonna still have the same catch up at the end that is going to be the same as the catch up here, right? Because you're going to earn this. What I did was I added all these together, right? And I just paid it all out at the end instead of during the investment, to give an example of how IRR goes down. But in this situation, the same recapture is going to happen when the project sells in year 5. So to answer your question, they're the same unless you have some big gain in the same year that you make the investment. So I always tell people, everybody wants to 1031 into syndications, and you can do that. We accept 1031 exchanges into our syndications through a tenant in common. But if people don't want to deal with a 1031, or they don't have property to sell, but they do have gains, passive gains, the loss that's handed out from the year that we buy the deal can shield those gains and can be an advantage to you. In this situation, you would only, let's say in the top, sorry to ramble on about taxes, but let's say on the top example, you had a $20,000 loss. Well, you only have about $3,000 of cash flow, but you could take that $17,000 loss and roll it over to years 2, imply $17,000 loss into 3901, and then so on and so forth. So you wouldn't be paying any taxes as you went. Now, obviously on the bottom, you wouldn't be paying any taxes either because you're not getting any distributions. So it's kind of the same depending on your tax situation.
Okay.
That was a lot of tax talk. So sorry if I put people to sleep.
That's-
But it's a loaded, really good question, good conversation starter. So the answer is it depends. That was really good. I think we lost Pablo on that one.
That's a good one.
Yeah.
Yeah, Greg, anything you wanted us to touch on?
Feel free to introduce.
My name's Greg Thomas, and I am Tyler's dad. And I have the fortunate opportunity to get an earful every night if he wants to give it to me. So I don't necessarily have a question at the moment.
Awesome. Whereabouts in Seattle do you live, or the area?
Mill Creek.
Oh, okay.
North.
Very good. Cool. All right. Well, yeah.
So Ryan, just a quick question. What is NNN? I actually see that a lot. The net. Is that a metric, or is that like something else?
It might mean triple net lease, unless you guys are tracking something else. Or a triple net tenant. Did we have that in our presentation somewhere?
I mean, where did you see it? Now we're curious.
Yeah.
Yeah, I saw it in one of the one of the properties that were being sold, and they said it is a triple N opportunity.
Oh, it's triple net lease. So what that
Okay.
means is that the tenant pays the insurance, maintenance expenses, and any repairs, or any like he basically pays all the fees and the rent. So a triple net is completely, so like let's say in that CVS example, CVS doesn't own the building, but someone else owns the building, but everybody pays for the CVS pays for everything. Light bulb goes out, property taxes, insurance. They pay the property owner rent. So it's a very hands-off operation.
Oh,
So, yeah, like we on our office space is triple net. Toilet doesn't work. Landlord says, "Okay, we'll go fix it then," because it's our responsibility.
okay.
Yeah. It basically, if you have a triple net tenant who's like an A-rated tenant with a long lease, that's a low risk deal, generally. If it's a triple net space in a low demand area and it comes without a tenant, then you have a lot of risk because it could take a long time to place a tenant. Do you have that deal? Do you know if it was like a CrowdStreet deal or something like that?
It was on. I can send you guys the link.
Yeah.
It was by this guy called Neil Bawa.
Oh, Neil Bawa. Yeah, I know Neil. Yep.
Yeah. So this is in Salt Lake City, Utah, and apparently Amazon and Facebook, they're going to have data centers there. So it is a very solid deal apparently, and they already have like commitments made. So.
Okay. Yeah, in that situation, I don't know anything about that deal, but I would be interested in the commitment and what that is. So like I would want like a copy of that document, and I would want to read and understand the level of commitment, right? Is it a verbal commitment? Is it contractual? Is it binding? Is there money lost if the commitment doesn't go through, or what binds the renter to those agreements and things like that? I would be concerned about that. Not concerned,
Right.
but I would just that would be part of my due diligence.
Right. So
Yeah.
this is the Woods Cross Flex Industrial in Salt Lake City, Utah.
Yeah, that sounds attractive. Office flex is doing, or I'm sorry, industrial flex space is doing very well. It's one of the highest performing asset classes right now. Better than storage. But obviously, doing your diligence on the operator and the opportunity, and that just because something is a good asset class or a good market doesn't necessarily mean that it'll translate into success. But that is generally a good space, very good space.
Yeah.
Maybe we can share that on our next. I mean, if you want to go through a lot like that deal, I mean, I don't know. I don't want to like embarrass Neil or anything, or go through something like that. But maybe it's something that we want to go through diligence on. Kind of explore the deal and kind of talk about the things that we would ask about. Right? That'd be kind of neat. So.
I was just wanting to propose that. I thought it would be a good idea when we just go and break down and write a question, what are the things we want to learn about this deal? What looks like good, bad, ugly, great, that kind of thing. So just a break. Awesome. Well, guys, I think we probably, unless there are more questions, we should just announce that the next meetup will be, what did we say, the 27th in 2 weeks on Thursday. And we'll see, stay either 4:30, 5 o'clock, or maybe do lunch. We're still, testing waters. Had quite a few people that couldn't make it today, but the meetup will be 27th. We'll have the next topic, and we'll definitely follow up with the recording of this event to the entire group, and we'll send it to you guys. Anything else you guys have to add?
No, it sounds great. We'll start a newsletter and an email as well, so look for that. And we'll try to get some reminders out for the next one. So,
Cool.
very good.
Thanks.
Thanks,
Well,
Tom.
thank you guys for joining us. Thank
Yeah,
you.
thanks.
Thank you. Thanks all.
Thanks, Amit. See you.
Well,
Yep.
Tyler,
Still there?
John.
What? You're gonna jump off?
Yeah, well, was good.